It's all about learning and staying on the learning curve. I think that's maybe also the best lesson you can give to your best advice you can give to your children.
I agree.
Because I think there's so many good books around, so many good sources of information.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
Market on close, TAS, block trades, that I think give you an interesting new dimension versus the very traditional volume and open interest type of analysis.
Yeah, no, absolutely. So once you've opened a position, you've entered a position with a certain size, can that size change, or will it only change when you close the position and you get a new signal?
No, that size can change first if you get stopped out. That naturally, but also if you are reaching some partial profit taking based on the different scenarios of the expansion of the market, if you're speaking from the long side, or you have those several standard deviation type of move in your favor, where you think that's the best way to maximize your profit and you exit everything, you go to the sideline. But also you can have different intermediate steps based on the shape of the evolution, where basically you can have a model that transforms himself from a short-term breakout model to basically a smaller short-term trend, i.e. when you're after a breakout happen and you reach a specific level where you think that the probability of mean reverting or observing further expansion, those probability are equal, then that's where you take your partial profit taking. And it's in the second part where you are re-engineering your money management in order to consider that now you add enough P&L to be reinvested as a buffer to turn your model from a breakout to a trend model. So that's also an avenue where you can have the model that stay as they are and the one that are where that position is evolving to the next stage. And that's where the position sizing happen after mainly that intermediate or partial profit taking.
Got it. Could it also change as a function of volatility that your system experiences?
There will be a recalibration of the token based on the evolution of the volatility during the life of the position. Right. But if volatility decline, the position will not be increased.
Okay, so you're not adding to an existing position, increasing your risk?
We do not.
Okay.
We do not, because as we are mid to long-term traders and we have filters, as we are very picky in our participation in the market, it means that if we are adding to an existing position and there's a sort of change in the momentum, we will have degrade our entry price by adding to that position. That will force us to adjust the money management to get a tighter protection to that increased position by increment, and that would make us more vulnerable about being stopped out in case volatility start to increase at that stage.
Sure. Very good. One interesting thing I came across is, you've worked inside larger firms, Millennium, Stable Asset Management, and I was just wondering, what do you think is advantageous of that approach? What are the good things about that?
So I think that they are very different from each other. When you are in a sovereign pension fund in Canada, you really have access to a very large pool of capitals, computer and brain powers. And that enables us to really build the strategy. And then you are moving to a firm like Millennium, where your recipe has to be ready in place, and you've been hired and allocated capital to manage the money in a certain way. So I think where you have a lot of room for innovation, such like at the Caisse de dépôt et placement du Québec, we had to be extremely disciplined from a risk management standpoint at Millennium. And then Stable Asset Management was, as you mentioned them, they have been our partners that allow us to launch in an independent format when we decide to spin off from Millennium and become basically Arctic Blue Capital. And Stable has been a great partner and told us everything about marketing, launching your own firm, until Stable Asset Management sold their share to H2O Asset Management. And Stable is now really keep on going specialized on seeding and helping young firms to, in perfect world, to blossom.
Yeah.
But,
that's a very...
season varies.
Good, great.
Yeah.
How many people are you at Arctic Blue?
So Arctic Blue, we have 3 pure investment professionals, plus we have a pool of quant developers. And we are therefore purely focusing on investment and research. So all the non-investment function, which are legal, compliance, middle office, back office, risk supervision, distribution, we benefit from the H2O platform, and H2O today is managing 26 billion euros in different type of vehicles. So, and they are own themselves. Their main shareholders, majority shareholder is Natixis Group. So for all offshore products, we're benefiting from H2O distribution, and on all UCITS product, we're benefiting from Natixis distribution. So that right. allows us to really purely focusing on investment and research.
Great.
With my main partner, Philippe. We've been working with him for 11 years now, since Canada. I used to be at Northern Networks before. And third gentleman joined us from Mane HL Implementation Group. And then we have the Quant Development Group.
Great, thanks. So we've touched on your commodities program, and we've noted that I think in August of this year, you've launched an equities program. We'd like to learn more.
Well, thank you for the opportunity. So back to the journey, the equity program was launched in Canada. We were reporting to the CIO office, and clearly the pension fund had a long-only aspect and exposure to the beta. We are in second part of 2007. Valuation of market is clearly a bit high, but it's quite difficult to be fully contrarian at that level. But the need for protection started to become quite obvious for many, many market participants. So when we developed our model, and with a very equal allocation between the different styles for commodities, we looked at mid to long term and longer type of horizon for equities. And we found that short-term breakouts tend to be correlated with the trend. And we found that on very long expansion of the equity market, really the main value, the alpha generation, was the ability to identify reversal patterns that were most of the time more powerful than expected at the beginning. So we looked at the same recipe than for commodities. We looked at longer type of horizon, and this time we've been overweighting the contrarian family of models up to 80%. So it can range from 60 to 80%, but it's a very, very high weight. And we have a presence in the trend, which is capped and range between 20 and 40% maximum. And therefore, in a way, we are in the trend to finance our ability to be contrarian, because basically being contrarian in an expansion like the one we've been going through, it's the best recipe to die by 1,000 cuts. And, and therefore, you also have the ability to capture different type of dynamic through the reversal model, and mainly the midterm reversal model that tend to capture V-shaped type of move up or down. And we have no bias into the model. All the models are purely symmetric, long or short. We end up capturing a lot of rotation of sectors in the US, just because of the model being able to benefit from those abrupt change of direction between sectors, but not building position as long-short. But when you look at a portfolio snapshot, you can observe a lot of long-short position between the different sectors. And sectors historically have represented 45% of the allocation of the strategy. And on the other side, when you are looking at the trend and the contrarian positioning at global indices or country specifics, we can capture some of the geographical divergence. We look at episode like in 2010 with the beginning of the Greek crisis in Europe and where the US market were doing better, and more recently in February, or more recently even in August, where we've seen opposite type of trends with US market printing all-time high. But when you look at Europe, we're very, very far away from all-time high. So we had Chinese market down nearly 20% on the year at a certain stage. You have a very long-term bottoming out process in Japanese equities. So we are in an environment where also we observe a very nice type of dispersion we can capture through that multi-directional approach via the model. And therefore, we are trading 60 different indices and sectors. We do not trade single names.
And the sectors you trade through ETFs and the indices through futures.
Absolutely, most of ETFs and that's for the offshore version, and we have a UCITS version where we have the ability to replicate the position also through other instruments.
And on those contrarian models, they're all driven by price action. There's not like you're not taking in news flow or any other sources. It's all just prices.
So we take prices, implied vol, realized vol, and we are looking at convergence of divergence between those different data in order to identify regime change. And we have different type of reversal models. Some tend to capture over positioning and therefore steep consolidations, such as the one of February 2018.
Right, sure.
And, a bull trend tend to die from its own excess. Like a bear trend, if you look at 2008, 2009, kind of pivotal, with a little help from the Federal Reserve. And then you have the more long-term reversal model that capturing some structural change, like we mentioned previously in Japanese equities. But yes, there is no news considered as an input for the strategy.
Mm-hmm.
I was thinking just a little bit sort of, you mentioned that equities, they're a bit stretched perhaps at this time in the cycle, and Europe has already started to maybe, create some kind of downside momentum, and Asia as well, and certainly some parts of Asia. But those risks in general that I think we all feel that they're there in the markets. I was interested in just finding out a little bit about how you think about risk in general. How would you define risk when you look at your strategy, and also maybe what keeps you up at night? I mean, what are the things that you worry about when you look at these kind of strategies, but of course your own perhaps in particular?
Well, that's a very deep question, Niels.
Well, we go deep here on Top Traders Unplugged.
Yes. Things that are really the concept of risk for the strategy to start with is really for us the ability of distributing a maximum risk amount in a fixed way through the different models and through the different investment horizon and through the different underlying the different markets. And therefore, even if some of that risk is not used by some model, it's not redistributed dynamically. So we work at a fixed risk approach between the different markets, which is also maybe making us things a little bit more looking at a different angle than some other market participants.
Right.
We look at volatility as being a very good measure of the risk, and therefore it is difficult to forecast or to get confirmation of sustainable volatility regime versus the noise. And that also make us more binary in terms of approach than incremental, mainly due to the computerization of the market and the distribution of the volume, which is not as steady as it used to be before. therefore, for us, our risk approach tend to generate up to 60% of the performance itself.
Okay.
Now, in terms of what keep us awake at night, well, I think we start to get, even if we are all here seasoned systematic traders, and therefore emotions are not part of the game, I do think that we start to observe, and staying very humble here, potential conjunction of factors from geopolitical tension, trade wars, Brexit, emerging crisis. We start to see a lot of potential events at a time where central banks are withdrawing the liquidity that has been acting as a safety net under the market. So instead of extending that catalog of potential events, as systematic traders, I do think that we're good in an environment where we can capture, and we long convexity, so where we can capture tail risk, where we can protect our investors and play a mission in the portfolio of our investors. And therefore, I would think that most of investors have been driving on a motorway.
Sure.
A motorway where basically an entire generation of traders have only been and investors driving on a motorway, forgetting that at the end of the motorway, there could be more of some narrow road, curvy roads. And the risk we have is that US equities push even further up. And we are maybe in December 99, when NASDAQ was absolutely very overvalued, but you were going short in December 99. And by March 2000, you were maybe, down 30-40%. Sure. We have some emerging events that make think us about 1998 or 1995. So overall, we do not forecast anything. We're reactive. We're not predictive. But back to the inflection point of November 2017 and the change in the VIX market, for different reasons, we do think that we're on the way to a significant change of environment over the next few months or few years. And I really do think that midterm systematic traders, trend followers, multi-directional approach, and so on, will mini revert in terms of historical returns generation versus those years where basically the job of the CTA or trend followers have been in a way taken by the Fed. We've been observing that socialization of the risk, and there was no more tail risk being able to develop due to the fact that there were a wall of money being able to engineer that very long-term rally and that recovery in the economy that's been doing very well for most of the world. But the protection role and the ability to generate decorrelated returns by CTA and trend following seems promising with higher probability than a few years ago.
Yeah. No, I mean, I agree certainly on those points, and the risk that I see in a sense is really the risk that clients end up giving up on the strategies that will give them the protection because they haven't needed them. When you read some of the news letters coming out, even from some very, very large shops, the quote-unquote underperformance or lower performance than normal from some systematic strategies are causing investors to become a bit impatient. And I'm sure it's the same just before the tech bubble, when once everyone got invested in equities and there are no more people to continue, that's when these things happen. And it does seem to have some parallels today. But if we turn it around on the other side, are there some interesting opportunities you see? You've touched upon a little bit. I mean, for our industry, I mean, do you feel that there's also some positives from what is happening?
Yeah, I think China. China is clearly on the way to open its financial markets to a non-China-based institution. We saw the launch of the oil future contract denominated in yuan, and it makes sense. I think we'll see commodity markets really, and you look at the depth and the volume of Chinese commodity markets, they're really becoming extremely attractive, even if there are some significant barriers at entry. But when you are looking at the consumption of commodities from China in 1990, it was representing 5%. And now it's a bit more than 40%. So I really do think that at the same time, you see Japan over the same period went down from 12 to 5. Also, Europe declined, US declined. So I think that there's redistribution of economic growth, but which is now validated by financial markets. And we do hope that those markets will open, because in terms of opportunities, that could be absolutely a phenomenal for most of us.
We'd all like that.
Yeah, we'll like that.
Do you have anything more on the strategy, Moritz, that you want to?
No, I think we're good. I really enjoyed that. Thanks for all the background and the detailed information about the two programs that you run.
Yeah,
it's been great.
Yeah. Now, I want to go and talk a little bit about, you've been around for a long time, and I think it's always interesting to try and summarize some of these experiences that we all collect as being practitioners in our industry. So if you think back over the many years you've been doing it, are there certain things that you would say have stood out to you as sort of the key, some key principles that you like if, for your kids, for example, that you would pass on to say, that, if, in your life ahead of you, these are some of the things that you should consider or bear in mind? Is there something that stands out to you from your career?
Well, absolutely, but now we turn a bit more philosophical.
Well, that's fine. There's
we deep on
we're deep. We go deep again.
No, I really think that the quality of the individuals you have the chance to meet, to work with, and therefore the importance of nurturing those relationships, your team, your investors, your partners. I think it's a long and beautiful story. On a daily basis, I think it's all about habits that create processes that help you to stick with a very disciplined approach. So from very idiosyncratic aspect of our job, such as signal implementation, risk monitoring, but speaking about life and about our children, it's really being able to wake up every morning and thinking positively about what you could achieve. And that seems very obvious, but it's all about your mindset. And your mindset will start by some routine. And those daily routine, I think, help you to stay cold-minded in moments where you are getting challenged. And I think that the markets have an amazing ability to humble you all the way.
Yeah, no, that's very true. So, you meet a lot of investors looking at you and from this industry, and I certainly felt through my career that a lot of investors were asking the same questions. And I remember once, in the old days when you had these templates of due diligence questionnaires, and you could, basically you could see all their questions coming from that source. So I've always been curious to find out what my guests feel are the questions that investors should really be asking. What are they missing out in terms of trying to understand perhaps better what we do as an industry, which hopefully will also allow them to hold on to these strategies during the times where maybe less informed investors would pull the plug, so to speak. What are the questions that you think investors are missing as part of their general due diligence? Not saying all of them, but perhaps most of them.
I think in our industry, in our part of the industry, systematic trading, most of us are trading listed instruments. The room for error, the room for fraud, the room for misunderstanding has been really quite well mitigated. It's very minimal compared with all non-listed, illiquid type of structure. I think also the regulators have played a big role, and a very positive role, to protect consumer and investors since 2008. And I'm thinking really all the regulators in the United States, but also in Europe, that have been quite key about making the due diligence job easier in a way. I think the frequency of audits, the audits based more on snapshots during the year, the regular inquiry by regulatory bodies, I think also are adding safety nets for investors. So in terms of due diligence, from the investor to maybe, I would think that there are all the formal points and all the formal, very traditional question regarding the processes, the logistic. But I think that the conversation with the portfolio manager or the teams, giving the ability to the investor to understand the nature of the product and having the best possible expected behavior of that investment in the portfolio. I think that it's more than the due or it's taking more a sort of a deep understanding of the strategy and not being purely blurred by a specific set of number on a specific period. I think it's extremely important to have that level of confidence from the investor where he can expect on different type of market environment how this investment will behave in the overall portfolio. So it's more an IDD with sort of psychological dimension than purely a due diligence process that I think is becoming extremely thorough now. And thanks also to the regulatory framework in place since 2008.
Yeah. I mean, just wrapping up, so to speak, but I mean, you mentioned the advantages you've had being part of bigger organizations in launching your own firm. I was just curious, I mean, have you had any mentors, you would say, if I can call it that, through your career that has helped, or are there any books, any literature that you where you say that really helped me evolve as a manager that you can maybe recommend to our listeners as well?
Sure.
Besides listening to Top Traders Unplugged, of course.
Absolutely. Thank you. That was my first point in my
of course, I'm sure it was.
No, I think podcasts are really amazing. There are very few good ones around. I think also in terms of books, some of the Peter Bernstein books on risk, Reminiscence of a Stock Operator, and the story of Jesse Livermore, a classic, absolutely. The book of Andrew Lowe about adapting markets. I read a lot. I think it's all about the conversation I had with Moritz just before our discussion. Yeah. It's all about learning and staying on the learning curve. I think that's maybe also the best lesson you can give to best advice you can give to your children.
I agree.
Because I think there's so many good books around, so many good sources of information, so many, in terms of mentors, I didn't have the chance to be taught by Paul Tudor Jones or
Richard Dennis or something like that.
Dennis, or a legendary person like this. But through the years, I had the chance to meet Ed Thorpe or
great.
Jerry Parker, that I think you know well, or these gentlemen that are so humble with very deep experience in markets and at human level, that any conversation with them is an amazing opportunity.
Yeah. Anything we missed that you want to bring up as we come to conclusion? Something you?
No, I really enjoyed this conversation. I'm very honored to be your guest. Thank you both of you for your very interesting points that you gave me the opportunity to extrapolate on. I really enjoyed that moment. Thank you very much.
No, absolutely.
You're welcome.
On that note, let's wrap up this fascinating conversation recorded live here in the famous Abbey Road studios in London. JJ, thank you so much for being on the podcast and sharing your thoughts and experience with Moritz and me. It is so important to have practitioners like you share these ideas, because when ideas become conversations that lead to action, that's when real change happen. And to all our listeners around the world, let me finish by saying that I hope you got a lot of value from today's conversation and that you enjoyed it as much as Moritz and I did for making it. And if you did, please share these episodes with your friends and colleagues so that the conversation can continue. From me, Niels Castro Larsen and Moritz Seibert, thanks so much for listening, and we look forward to being back with you on the next episode of Top Traders Unplugged. And in the meantime, go check out all the amazing resources that you can find on the website.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.